What if I told you the very thing you rely on to build wealth through property might disappear overnight? That's what many property investors are facing right now. With the government reviewing billions of dollars in tax concessions, including negative gearing, the rules of property investment could change drastically. But here's the opportunity. While some people are panicking, savvy investors could take advantage of these changes and set themselves up for long-term financial gains. In this video today, I'm going to break down how negative gearing works, what could happen if it's removed, and more importantly, why the window of opportunity for investors is open right now but might not stay open for long. I'll show you how to take advantage of these changes and position yourself strategically for long-term financial gains. Stick with me because by the end of this video, you'll know exactly how to move forward. And I'd love to know, are you for or against the removal of negative gearing? Please comment below. Hey guys, I'm Raphael, author of Property Wealth Blueprint and founder of Get Rare Properties, an independent buyer's agency. Welcome back to Property Investment Insights with Raphael. If you're new here, make sure to subscribe for expert advice on growing your wealth through smart property investments and make your hard-earned money work harder for you. And if you are serious about buying property the right way and scaling up your portfolio without much hassle, I'm offering a free strategy call to help you build a risk-aware property portfolio that can generate $100,000 in passive income. Just hit the link in the description below to book your call. Now, back to the topic. Let's start by understanding what negative gearing actually is. In simple terms, it's a tax strategy that allows property investors to offset losses from their rental properties against their taxable income. This makes owning a rental property more manageable, especially when rental income doesn't cover all the costs upfront. For example, say your investment property brings in $20,000 a year in rental income. Sounds good, right? But your expenses, including mortgage interest, property management fees, and maintenance, total $30,000. That actually leaves you with $10,000 loss for the year. Now, without negative gearing, you'd simply have to absorb that $10,000 loss. But with negative gearing, you can deduct that loss from your taxable income, reducing the amount of tax you owe to ATO. Say, if you're on a 37% marginal tax bracket, your tax liability gets slashed by $3,700 for the $10,000 loss you make on the property. This system has helped many Australians manage their properties while they wait for long-term capital growth. In financial year 2022, around 2.3 million Australians declared rental income and nearly 950,000 landlords reported a loss. Negative gearing helps investors cover those short-term losses and maintain their property portfolios over the long term. But what happens if negative gearing is abolished? One of the biggest concerns is the economic ripple effect. The property sector plays a critical role in Australia's economy. It supports jobs in construction, real estate, finance, and even retail. Property investment drives demand for new housing, which keeps construction activity high, and with that comes employment and economic growth. If negative gearing is removed, we could see a significant drop in investor demand, especially for new builds. This could lead to fewer new homes being constructed, which would impact not only housing supply, but also jobs in the construction and real estate sectors. To put it simply, fewer investors means fewer homes built, which pushes up rents, and it doesn't stop there. Finance and retail industries also benefit from property transactions. Think about all the spending that goes into furnishing new homes or taking out mortgages. If fewer people are buying investment properties, that's less demand across a range of industries, and the broader economy will feel the effect. One of the misconceptions is that negative gearing only benefits the wealthy. Opponents of negative gearing argue that it primarily benefits the wealthy and that removing it would lower house prices. But the truth is, many middle-income Australians rely on it to build their property portfolios. In fact, over 60% of property investors using negative gearing earn less than $100,000 a year. These are everyday Australians, teachers, nurses, retailers, and tradespeople who are using property investment to secure their financial future. For many of these investors, negative gearing is a way to supplement their income and plan for retirement. It's not about tax dodging. It's about making property investment viable for regular people, not just the wealthy elite. removing negative gearing could disproportionately impact middle-income Australians, forcing them to sell their properties or increase rents to cover costs. Which brings us back to the issue of rental affordability. So while it may seem like a simple fix to housing affordability, abolishing negative gearing could actually make things harder for renters and mom and dad investors. Well, you know what? We don't have to speculate about what happens when negative gearing is removed. We have actually seen it before. Back in the 1980s, the Australian government temporarily abolished negative gearing to try and control the housing market. The result? Rents skyrocketed, particularly in major cities like Sydney and Perth, where rental demand was already high. The situation got so bad that the government was forced to reinstate negative gearing just a few years later. So history shows us that removing negative gearing won't fix housing affordability. It will make it worse. Less investment in rental properties means fewer homes available, and that leads to higher rents. It's a simple case of supply and demand, isn't it? So what does the future look like? Well, I predict that removing negative gearing will create short-term volatility as investors react to the uncertainty. But here's the thing. In the long term, the fundamentals of property investing will only get stronger. Demand for well-located, high-yield properties is going to increase, and those who hold onto high-growth properties will come out on top. Personally, I believe that negative gearing may still stay, but even the dip in sentiment is enough to create a massive opportunity for those who act now. Investors who are ready to make smart, strategic decisions are going to benefit while others hesitate. Here's the bottom line. Timing is critical right now. With all the uncertainty around negative gearing, many investors are hesitating. But this is a golden opportunity for those who focus on high growth, high demand areas. Properties in well-located areas with low vacancy rates and strong rental yields are only going to become more valuable as supply tightens. If you secure those properties now, you'll be in a strong position to benefit from rising rents and capital growth in the years ahead. Well, let me share an example with you. Kate and Raphael, they are not wealthy elites. They are regular investors who, during the COVID years, focused on fundamentals while many other buyers were hesitant, unsure of the market's direction. Rather than sitting on the sidelines, Kate and Raphael identified properties with strong rental demand and capital growth potential. They didn't buy for tax breaks. They bought because they understood the fundamentals of location, demand, and long-term growth. Fast forward a few years, in just a short span of time, their portfolio grew by more than $500,000, all because they stuck to smart strategic decisions when others were unsure. What if you had invested like Kate and Raphael during COVID? Think about how much your property could have grown by now. Imagine if your portfolio had 2 or 3 high-demand properties. What would that do for your financial future in the next 5 years or so? Now, let's talk about what happens if you don't act. Picture this. Rental supply shrinks as fewer people invest in property, which means rents start climbing. Suddenly, you're left paying higher rents or missing out on properties that skyrocket in value. By hesitating, you risk being priced out of high growth areas and watching others take advantage of the opportunities you passed up. In just a few years, you could be thousands of dollars behind because you didn't move when the market presented an opportunity. Now, let's flip the script. Imagine if you took action today. You secure properties in high demand areas and lock in strong rental yields. With capital growth on the rise, you are not only seeing your portfolio grow, but also passive income flowing in. Just like Kate and Raphael, whose portfolio grew by more than $500,000 in a short span of time. And you are ahead of the curve, making smart investments before others catch on. The choice is clear. Wait and watch your opportunities slip away, or take strategic action now and set yourself up for long-term financial success. The window of opportunity won't last long either. With fewer people buying, off-market deals, which make up 85% of our secured properties, are more accessible than ever, giving you a chance to snap up the best deals before the market catches on. You don't have to be caught off guard by these changes. With the right strategy, you can capitalize on this moment and set yourself up for financial success. It all comes down to understanding the fundamentals and making smart moves now. You have 2 options right now. You can wait and watch how the market plays out, or you can take action, just like Kate and Raphael did, and set yourself up for long-term success. The choice is yours. If you found this video helpful, don't keep it to yourself. Share this with your network and help them make smarter investment decisions. Make sure to subscribe for more insights on property investing and building wealth. And I'll see you in the next video. And just a quick note, everything I've discussed here today is general in nature and not meant as a specific financial advice. Make sure to consult with a qualified financial advisor before making any major investment decisions.